when it comes to the AI race. Lastly, let's talk about quarterly index rebalancing. S&P 500 as of December 22nd will now be including the shares of Carvana. It seems like the market, this found the market a bit unexpected. We are seeing shares of Carvana up some nearly 9% so far in pre-market trade. Bonnie?
Fascinating. Valerie, thank you so much and happy Monday. Also coming up in this hour, we'll be looking ahead to a busy week of data and that Fed decision with Sonia Martin of DZ Bank. Our top story this morning, President Trump responding to the Netflix-Warner Brothers deal.
Well, that's got to go through a process, and we'll see what happens. Netflix is a great company. They've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him. But it is a big market share. There's no question about it. It could be a problem.
Joining us now is Bloomberg Deals reporter Manuel Baigori. So, Manuel, we have exclusive reporting that said that Ted Sarandos spoke to Trump about this in November, and Trump said that Warner Brothers should go to the highest bidder. Now, he didn't say anything about antitrust concerns. How much can the president actually sway what happens next?
Yeah, Vonnie, what an amazing deal, right?
That will certainly give some comfort to the doves in the committee. But the thinking is they might say, let's go month by month next year and see where inflation is. But I think right here, right now, the thinking is they will go this week because they are more concerned about the jobs market. And then as we get more official data coming in over the months ahead, they'll have a clearer picture on where jobs and inflation are and probably give policy a sharper focus as we head into the new year.
And Karen covers the gamut for us there in Washington. Our thanks to you for joining us this morning. Let's continue that conversation now because we do have a week of central bank decisions likely to keep FX traders pretty busy. A little pressure on the dollar in the run-up to the FOMC as traders weigh the health of the U.S. economy and, of course, a potential Hassad succession to the current Fed chair. Joining us now is Sonia Martin, head of FX and monetary policy at DZ Bank. Sonia, just following on from what Enda said there, what can Powell say on Wednesday, assuming there is a cut, given that he already said you slow down in foggy conditions? Did the conditions suddenly get less foggy in the last few weeks?
No, they certainly haven't gotten less foggy. They will get a little bit less foggy after the FOMC because that's when we're going to get some key data points coming in, the CPI and, of course, the labor market report. The Fed is likely to cut, as was just mentioned, and I think the best strategy for Jerome Powell is to accompany this with some very cautious wording. He's likely to highlight the fact that the future path for monetary policy in the U.S. is not set, that the market should not expect successive rate cuts at the upcoming meetings. And I think that's going to be designed to sort of make clear that the Fed continues to act in a very data-dependent manner and will not be pressured into more aggressive cuts also by the White House. So I think that's going to be the wording to accompany this cut. So it's going to be a cut with a cautious, maybe slightly hawkish tone in the statement.
Sonia, does the decision or the SEP, if it changes or even if it doesn't change, move the dollar? Or do we have to wait for decisions out of the Bank of Japan and the ECB as well?
I think the market obviously is set for a rate cut from the Fed. It's fully priced in at this point, so it's not going to be a massive surprise. Maybe depending on how careful Powell is in his wording, that could give the dollar a little bit of a lift. But having said that, we are waiting for the announcement of his replacement. We all know it's probably going to be Kevin Hassad. The White House has yet to officially confirm this. And to be honest, I wouldn't be surprised if Trump chose a moment soon after the upcoming Fed meeting to maybe make this announcement, which could then put some pressure on the dollar yen.
Why would it put pressure on the dollar yen? At least we'd have some kind of certainty, although obviously if it was a nominee, that person would have to go through the process of getting confirmed and so on. But there would be some kind of certainty as to at least what the lookout would be.
Well, I mean, Kevin Hassad is probably one of the more controversial suggestions or nominees that we had for this job. I mean, I think the market had other preferences. Kevin Hassad is considered to be very close to Trump, and he's likely to be quite dovish. I mean, I'm not saying that the Fed independence is going to be, necessarily will be threatened severely next year. But of course, there is that issue. We don't really know how that's going to play out. We don't really know exactly who's going to be on the board. There are some other question marks. Who's going to replace Steve Moran, and what's going to happen to Lisa Cook? So there's a few, there's some question marks. There's also some concerns that Trump may try to influence the rotation of the regional Fed members. So there's that uncertainty. But Kevin Hesed is certainly seen as someone very close to Trump, and I think he sort of suggests that we're definitely looking at a more dovish Fed going forward.
Sonia, what does the steepening of the yield curve, and indeed just the yield curve going higher this week, what does that tell you as an FX strategist?
Well, I mean, we have seen obviously a lot of volatility in this market this year and the previous years. The fact that the yields have risen again, I think there's several factors at play. On the positive side, you could note that people have become, I think, somewhat more optimistic on the prospects for the U.S. economy in general. We have seen some pricing out of more aggressive rate cuts, over the last few months. We have also seen some concerns on the other side on fiscal policy and the fact that, we had a long shutdown that's going to place an additional strain on the economy. Fiscal spending is an issue in the U.S. and will remain so for the years to come. So that's kind of the factors that are playing out here. I think the 10-year yield in the U.S. is going to continue to rise moderately, sort of very much reflecting fiscal concerns, whereas, of course, in the short end, we have more Fed cuts coming our way. So that does suggest that the curve will steepen somewhat more.
I have to ask you about the ECB and particularly Isabel Schnabel. She told Bloomberg exclusively that, if she were to be the next ECB head, if she were asked, that she would be ready to do the job. Would she make a good person to succeed Christine Lagarde, whose term is up in less than 2 years?
Well, I think she'd certainly stand for a very credible policy. I'm not sure, to be honest, what her chances are. I mean, there's a lot of politics involved in this choice. She is definitely known for having strong views on monetary policy. So I think that's a good thing. Again, I'm not sure what the probability is that she will succeed Lagarde, but I think it's the most important skill to have when you take that position is to communicate clearly with the market. And I think we've seen in the past, we've certainly seen some ECB presidents that have had some issues with this. Christine Lagarde, I think, sets a very high standard for whoever is going to succeed her.
For sure. The euro has been strengthening, right, in the last few days. Is that more of a dollar story? And where do you see it, given all the cross currents? Where do you see it, into the new year?
Well, I agree with you. I think it's mainly been a dollar move. We've seen the dollar weaken pretty much across the board. As the market focuses on this upcoming Fed rate cut. The euro has very little, strength of its own right now. We are in a very difficult economic situation in the Eurozone, particularly when we look obviously at Germany, a government that's been struggling to find majorities for key laws that had to be passed through Parliament last week. And of course, a big reform agenda that doesn't seem to be tackled at all at the moment. So all of that is speaking against the euro right now. Into next year, I'm a bit more optimistic on growth in the Eurozone. So we are looking for a somewhat stronger euro. But I think, to be honest, something slightly above 120 is probably going to be the end of that story, just because, it's easy to be dollar bearish. It's much harder to be euro bullish.
That's a good way to end things. Sonia, thank you so much. Enjoy the week. It's going to be fun. That's Sonia Martin of DZ Bank. Now to other top stories trending on the terminal this morning. President Trump expressing disappointment in Ukrainian President Volodymyr Zelensky's handling of a U.S. proposal to end the war with Russia. The U.S. said its negotiators had agreed with Kyiv on a, quote, framework of security arrangements. However, there was little indication of a major breakthrough. Unilever's Magnum ice cream starts trading today in Amsterdam, London and New York. The spin-off was valued at more than $9 billion. The company, which owns the Ben & Jerry's and Cornetto brands, is debuting a month later than initially planned after the listing was delayed by the U.S. government shutdown. Billionaire Alan Howard, whose hedge fund is the largest operating out of Abu Dhabi, said the Gulf city was well on its way to joining Western centres like London and New York as a global financial hub. The region's pro-business regulation, UK rule of law and time zone that allows trading across regions have transformed Abu Dhabi, according to Howard. Coming up, President Trump throwing cold water on the Netflix Warner Brothers deal over antitrust concerns. More next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophy.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Bersecci. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump has responded to Netflix's plan to acquire Warner Brothers. Take a listen.
Well, that's got to go through a process, and we'll see what happens. Netflix is a great company, and they've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him. But it is a big market share. There's no question about it. It could be a problem.
Joining us now is Bloomberg's Lonnie Prinsloo. So, Lonnie, what is next? Does it potentially happen that Netflix has to reconfigure this kind of deal, or that the other bidders might even be back in the game?
Yeah, so as you heard, Trump came out with concerns around the combined market value of Netflix and Warner Brothers, saying that it will have to go through a lengthy process with the U.S. Department of Justice over antitrust concerns, and that he will be a part of vetting that deal. That, of course, is significant because Trump also has ties with Paramount CEO Larry Ellis, and Paramount came out with the first moves on Warner Brothers. So there is a number of antitrust concerns, and we will have to see how Warner Brothers go about this. Even the polls, Polymarket said 60% chance of this deal coming through in 2026. Before Trump's comments, after his comments, it was only at 23% that the deal would come through in 2026.
The betting markets obviously think Trump's got some sway, or that his word means something about the antitrust division of the Justice Department. But Netflix does have an argument for the deal. It obviously is going to say that it's going to be better for the consumer. What is that argument?
Sure. So Netflix is coming out saying about 75% of HBO's streaming customers are already part of their platform, and of course customers can benefit from bundle pricing. There's also an argument that their competitors are not just a Paramount or a Disney. Their competitors is a TikTok, it's a YouTube. Even so, if you take the combined revenues of Netflix and Warner Brothers, their revenues are already more than that of YouTube. And of course, it's a massive platform that will be created with more than 450 million subscribers.
Yeah, a lot of subscribers. Lonnie, thank you so much. We'll continue to follow this with great interest. That's Bloomberg's Lonnie Prinsloo. Ed Yardeni of Yardeni Research is now recommending investors underweight the Magnificent Seven tech stocks versus the rest of the S&P 500. He spoke with Bloomberg's Haslinda Amin.
I've been recommending overweighting information technology communication service since 2010. The problem is it's worked all too well. The two sectors now account for a humongous 45% of the market cap of the S&P 500. Of course, their earnings share has also increased, but nowhere near as far. And the same thing can be said about looking at the U.S. versus the global economy. When you look at the U.S. MSCI relative to the world MSCI index, what you see is the U.S. now accounts for 65% of the market cap of the world stock market. So it's hard to recommend overweighting something that's already quite overweight. I mean, if you just told people just to maintain the current weight of the index, that would still be an overweight position relative to what most people would think would be a diversified portfolio.
And what's fundamentally changed? Because when we talk about, overstretched valuations, they've been that way for a very long time now. And when you take a look at the AI cycle, people still point to how it is still at the nascent stage.
Well, I would say with regards to the Magnificent Seven, what's I think has changed is they're competing more aggressively against each other, and they've got more competition coming out of nowhere and somewhere on a regular basis here. We recently saw that Google introduced Gemini 3, which suddenly made everybody kind of reconsider just how strong the position is of OpenAI and OpenAI's relationship to lots of other AI-related companies. And then just at the same time, DeepSeek came back. Remember, DeepSeek, when it introduced its model back in January of this year, kind of shocked everybody because they were able to put together a pretty good AI model that worked as well as some of the other ones in the United States, but apparently it was trained on chips that cost a lot less. And now it looks like they're doing it again, and there's some talk that the latest version of the DeepSeek model is just as good as Gemini 3. So there's a lot of competition. The profit margins have been awfully high for the Magnificent Seven. That usually invites a lot of competition, and that's exactly what's happening.
Ed Yardeni there. Coming up, we'll get you set up for your trading week. This is Bloomberg.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
On a visual.
And the analysis you need.
China's not going anywhere, nor are we.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead this week. One more piece of jobs data ahead of the Fed decision, with JOLTS job openings coming out on Tuesday. Then the main event, a Fed rate decision Wednesday, plus, of course, Powell's news conference and the SEP. And Fed Speak returns with Paulson, Hammack and Goolsbee all set to speak Friday. Let's take a look at some micro movers now, the ones that are moving before the bell. Warner Brothers, for example, down 1.5% on Trump warning that the Netflix-Warner deal may pose an antitrust problem. So you have Warner Brothers lower, Netflix actually higher this morning off the back of that. IBM down about 0.2%. The Wall Street Journal is reporting that it's close to buying Confluent. It will be an $11 billion deal if it does in fact happen. And Carvana will join the S&P 500. So it is up close to 10% in the pre-market. Let's take a look at the macro environment now. We have futures pointed higher and indeed gaining ground as we head through the morning. This, of course, as we look towards a Santa Claus rally, potentially. The two-year yield up another basis point. We did move a little higher last week, 357. Now the whole yield curve has moved higher. And copper at a record. China is going to boost domestic consumption next year. That's just one of the things going on with that precious metal, up 30% already year to date. That's it for Bloomberg Brief.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks happening everywhere, and that's what AI is most helpful in improving.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Financial conditions are easy. I mean, the stock market is hitting new highs almost every day.
We prefer to take our risk in the large cap space. We just want to be where the earnings are.
We're going to see a broadening out. We think that more boats are going to be rising.
We see another year of above average earnings growth next year for the S&P 500.
The U.S. bond market has been the envy of the world.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Looking ahead to a key Fed decision as traders position for more rate cuts. Oracle earnings on deck with Ed Yardeni underweighting big tech for the first time in 15 years. And Netflix's big deal sending reverberations through Hollywood, but Trump casting a shadow of doubt where suddenly it seems like less of a given that this deal is going to go through.
Well, it needs to go through a process, which the president did say last night. But then he also said, quote, but as a big market share, it could be a problem. The issue is the president normally doesn't get involved in these types of issues. His DOJ, though, of course, will review this. At the same time, in the same breath, the president was talking about how he did meet the co-CEO of Netflix. The conversation went well. So potentially, he's looking at some of the other players in the arena, like his friend, Larry Ellison, and his son, and looking at potentially if this deal falls through, could there be another bidder at the end of the game? But you saw immediately in Polymarket, those individuals that are betting that this was going to have a clean-cut, easy approval when it comes to Washington, those quickly sank.
Yeah, 60% to 25% chance this would actually go through, and you see the pricing start to reflect that. A question of the politics of this with respect to President Trump, his relationship with the Ellisons, and the potential reemergence of Paramount Skydance, and then the debt market side of this, the sort of market acceptance of this, given the fact that there's a $59 billion bridge loan, and a real question of how much appetite there is to finance M&A that seems to be coming fast and furious.
Well, we've already seen that with some others, that there has been questions in the debt market that is this just too much when it comes to the AI space. Also, when it comes to Netflix, how are they going to talk about this? I think for Netflix, it's not just the fact that it's YouTube. They're going to talk about things like TikTok, Disney. There are other streamers that they're going to say, actually, we need this to maintain a competitive advantage.
And a key focus is going to be on the Fed decision and just how much the Fed does make a more accommodative backdrop for these deals, for the debt markets. On Wednesday, a sort of lame duck Fed chair has to come out and say something that everyone will ignore. But there is this issue that we have not gotten 4 dissents on the FOMC board going back 30 years. Yet this could be the most split decision that we've seen in decades.
So it's going to be interesting as everyone pretty much thinks the Fed's going to cut. Who dissents, how many that number is, and then, of course, what is the rhetoric that Jay Powell comes out with? How does he talk about this interest rate cut, given the fact, as you said, we have been in a data desert? They are really relying on what we had before the government shutdown, second-tier data, and how do you say that you are data dependent when at the moment it is still quite foggy?
Right now, this is the last big week of the year. Really, it feels like that.
Well, then we have jobs.
We have the jobs report. Okay, trickling out on December 16th. We do have a pretty big week of data, of earnings. Tomorrow we get the JOLTS data for both September and October, or October and November, I should say, coming out. It gives a sense leading into the Fed rate decision. We get the employment cost index ahead of that rate decision. Then Oracle earnings, Powell's press conference that will give us an indication potentially of where the dominant strain is on the committee, and then jobless claims on Thursday. We also get Broadcom earnings and a host of auctions throughout the week. Right now in markets, what you can see is a little bit of a lift, an effort to get back to those record highs after a week of gains on the S&P, on the NASDAQ, with a real optimism that there will be this melt up, the Santa Claus rally up 0.1% on S&P futures. You are seeing copper surging to record highs. A question here, how you finance the real economy as both China and the United States are building out their infrastructure at all speeds. 10-year yields, watch this space at 4.15%. Last week, we saw the biggest increase going back to April of 12 basis points in the 10-year. And Brent crude just slightly lower. Coming up this hour, Christian Nolting of Deutsche Bank Private Bank with stocks on the brink of record highs. Victoria Fernandez of Crossmark Global Investments on why markets may reprice future rate cuts. And Robert Fishman of MoffettNathanson as President Trump pumps the brakes on the Netflix Warner Brothers deal. We begin this hour with stocks rising as traders increase risk appetite ahead of the Fed's rate decision. Christian Nolting of Deutsche Bank Private Bank writing, given the positive macro environment, we expect 2026 to be another constructive year, albeit with continuing market volatility. Christian joins us now. Christian, wonderful to see you. Thank you so much. So let's talk about 2026. Yes, continued volatility. Is there a sea change in where the leadership comes from, akin to what we heard from Ed Yardeni, where suddenly big tech doesn't cut it for leadership? Everyone is a tech company.
Well, I would say we still count on tech, and that tech delivers earnings. We do, though, expect that earnings growth is coming down a little bit, which I think is really healthy. But of course, earnings will be very important, and those companies who won't deliver earnings in 2026 will certainly get, say, punished, and that could cause volatility in the market. It's, by the way, one of the reasons why we are saying probably for 2026, let's not be complacent and just expect the same really positive performance we've seen so far this year, and likely to get into year end, I hope. So from that perspective, that's something to watch. But I still think that AI is not a bubble. I think it's still a boom and a structural change. And that's why we are constructive for next year as well.
Do you think that the United States is still the epicenter of that constructive change? That was also a big part of Ed Yardeni's call, is that the U.S. has benefited disproportionately to this point, and that is poised to change.
Well, I still look very easily at productivity, and that's the highest in the US. And honestly, I don't think that's massively changing next year. Look at Europe, for example. The productivity is far behind the US. Hopefully that's getting better with fiscal policy here, but to be seen. But I think to catch up on the US productivity is very, very tricky, at least in the short term. So longer term, maybe, but it's a long way to go. And from that perspective, I think we have seen this year but then with the investments coming in, I would say that's continuing.
You make a good note in your research about how the government stimulus we're going to get from the United States when it comes to the One Big Beautiful Bill is going to be timed after 3 Fed interest rate cuts. So, Christian, looking at next year, do you think the Fed needs to cut any more?
Well, I think if you look at the absolute level, I wouldn't be surprised if we see 3 cuts. So starting probably this week with the first, and then 2 more into next year if you look at a 12-month time horizon. I think that could be justified because although there is fiscal spending, yes, and increasing, but I would say at this point in time, and you rightly said we don't have all data yet, but I think the US is a bit in a weaker spot. On the other hand, something I think very important we also say in the outlook is inflation. So if you look at the 10-year US Treasuries, we think they could be 4.15, like exactly where we are right now in 12 months' time, because inflation remains a topic. So we don't see inflation to substantially come down, but even go up slightly from 2.8 to 2.9. That's our forecast.
You also think that policy will deliver a cyclical impulse in Europe. What kind of policies are you looking at? Because Europe at the moment, especially seeing the data out of China, is struggling.
That's correct. But of course, I look at the largest economy, Germany, not because I'm obviously in Germany at this point in time, but so far it was roughly not growing, so 0%. And I do think it could go to 1.3 to 1.5 next year because not of monetary policy of the ECB. There we do expect the ECB to stay steady at 2% for the whole year next 2026. But it's fiscal policy, and that's why we see that government spending, which is coming now. It was a bit delayed, I have to say, but now we see that really happening, which is good news.
Christian, how much is your constructive outlook next year really predicated on this idea of fiscal and monetary support from the United States in particular, but also globally?
Well, it's a major source of growth, absolutely. In the US, we do see Germany especially doing something. It's a lot of fiscal policy, but then the central banks as well. I think Bank of Japan, of course, is different. We expect 2 hikes there. But otherwise, if you look at monetary policy, we counted more than potentially 80 cuts of global central banks. I think that's quite a constructive environment per se, I would say.
Which is probably the reason why, if anyone has a deal to announce, let's announce it. That seems to be the mood of the morning, the mood of the week, and the mood of the month. We've certainly seen that from the likes of Netflix and Warner Brothers. We've seen that with the debt issuance from the likes of Oracle, which reports earnings this week, as well as Meta, as well as a whole host of the other tech names. I'm just wondering at what point you think that it's going to become too much for debt markets to finance, given some of the concerns about the structural changes in this industry.
Yeah, I think there's a lot of discussion about this, but I think it's a normal development. We've seen this in other major structural trend shifts that companies started at one point in time to use also debt because free cash flow was not always enough. I think I've not seen really some bond auctions struggling at this point in time. There's a lot of demand, and I think given all the discussion about sovereign debt, which is there because of all the fiscal policy, people look at also corporate bonds. And if that's an attractive yield, of course, they will go for this, especially if it's investment grade, which we still recommend, although spreads are quite low. So if I don't see a recession, which with all the fiscal policy is quite unlikely, I think then it's still an interesting investment. And again, I've not seen any bond auction struggling at this point in time. But of course, it's something to be watched.
Just heading into next year, Christian, what's your highest conviction trade?
I would still say it's gold on the one hand, to be very honest. On the other hand, what I just said, corporate bonds looks very interesting. On the equity side, with all that fiscal policy, I would say could also be constructive, but don't expect the same double-digit performance. I would be okay if it's like single-digit, high single-digit, say 8 to 9%. That would rather be our forecast.
Christian Nolting of Deutsche Bank, thank you so much for being with us with a gold call. As people continue to look to the precious metal, even though they are bullish on risk, it normally goes the other way around.
Well, also the PBOC just increased their holdings of gold in November, 30,000 ounces. So 13 straight months you see China continuing to amp up their holdings of gold. And what this year has taught us is that risk on, individuals buy gold. Risk off, individuals buy gold. This is something that people continuously want to put in their portfolio.
Especially due to some of the concerns about the fiscal monetization that we're seeing in a number of places. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vonnie Quinn. Vonnie.
Lisa, good morning. Thank you. President Donald Trump raising significant antitrust concerns over Netflix's planned acquisition of Warner Brothers Discovery. The president warning the deal, which would combine the dominant streaming service with HBO Max, creates a market share that, quote, could be a problem. The comments escalate pressure on regulators, signaling a potential lengthy Justice Department review. JP Morgan CEO Jamie Dimon issuing a warning for Europe in an interview with Bloomberg's Carolyn Hyde over the weekend. Dimon saying bureaucracy is weighing on the continent's growth.
Europe has a problem. I think they accomplished an unbelievable thing, but it got bogged down. It takes 27 nations, to make a decision. They have some wonderful things, but they've gone from 90% of the GDP of America to 65. That's not because America did anything bad to them. It's their own bureaucracy, their own costs. I think the leadership, Merz, Macron, Maloney, Starmer, I think they know. I just think politics is really, really hard.
Dimon adding the risks could have implications for the United States. And after a 15-year-long bet on tech, Wall Street veteran Ed Yardeni is going underweight the Magnificent Seven. Yardeni Research is now expecting a significant shift in earnings growth, suggesting that tech is evolving. Yardeni argues that the rest of the S&P 500 will see improved productivity and profits because, quote, every company is becoming a tech company. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, affordability front and center.
We are now seeing this affordability problem, and I think next year we're going to move on to prosperity. Now we are working on inflation, and I expect inflation to roll down strongly next year.
Former House Financial Services Committee Chair Patrick McHenry joins us next. Right now, stocks inflecting higher after a weekly gain on both the NASDAQ and the S&P. This is Bloomberg Surveillance. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Pushing back toward record highs once again, climbing into the end of the year. A real Santa Claus rally potentially reasserting itself, up about 0.1% on the S&P. As you do get a sense of dollar weakness also coming back into the fray, we have seen that sort of steady weakening as you have seen long-end yields grind higher. 4.15 on the 10-year. It has climbed 12 basis points last week alone, which is the biggest monthly sell-off in the 10-year going back to April. And copper at a new record, with everyone buying, China buying, the United States buying a build-out of AI. Under surveillance this morning as prices rise in some of the commodity sectors, affordability front and center.
What we're not going to do is say that Americans don't know what they're feeling. We've been working on it every day. Democrats created scarcity, whether it was in energy or overregulation, that we are now seeing this affordability problem. And I think next year we're going to move on to prosperity. Now we are working on inflation, and I expect inflation to roll down strongly next year.
Here's the latest. The White House ramping up its affordability push, eyeing options to bring down beef prices and address anti-competitive food prices ahead of President Trump's trip to Pennsylvania tomorrow. Bloomberg's Tyler Kendall returns to us. Tyler, great to see you once again. What are we expected to hear from President Trump tomorrow?
Yeah, hey, Lisa, good morning. Well, we know that this White House is trying to recenter its messaging on domestic issues, including affordability. And we are expecting President Trump to tout some of the recent actions that he's taken, including over the weekend signing that executive order that's directing the Department of Justice as well as the Federal Trade Commission to look into anti-competitive practices or alleged price gouging, all in a bid, of course, to bring down food prices. We do know the DOJ has launched at least one investigation into one key sector. You mentioned beef. That investigation is looking into meat packers, as the price of beef has climbed really steadily since the start of the pandemic. In fact, the Treasury Secretary Scott Bessent was asked about this and how it actually sort of continues a similar policy under the Biden administration, where we saw that administration launch and continue similar anti-competitive investigations. The Treasury Secretary alleged that that investigation was mishandled, but I did speak to one FTC commissioner over the weekend who told me that some of these probes may face some pushback, considering that we've seen these agencies significantly streamlined in a bid to reduce the workforce. Now, Lisa, we also got some reporting from the Wall Street Journal over the weekend that the administration is looking at some policy shifts. This includes potentially reopening the southern border to Mexican cattle imports amid a current ban that is in place in a bid to try to stem the migration of a parasite that has been impacting herds. But Lisa, at the end of the day, it is all about trying to get supply up, particularly when it does come to beef, in a bid to lower those prices for consumers.
Tyler, when it comes to affordability, one thing that continues to come up is also health care prices. Are we going to get a vote this week when it comes to those enhanced subsidies in Congress?
Well, Anne-Marie, it looks like we're heading towards that because, as you well know, Congress is only in session for about 2 more weeks before they break for that holiday recess, and there is a big push to get something over the finish line, considering that those enhanced Affordable Care Act premium tax subsidies are set to expire at the end of the year, and that is setting up a really big political fight. We've seen some different proposals put on the table. We are expecting the Senate to vote on the Democrats' proposal, which would be for a 3-year clean extension mentioned, that is not expected to reach that 60-vote threshold. But there are some other ideas brewing, including on the House side, potentially for a bipartisan compromise that would extend those premium tax subsidies for 2 years with some structural changes, such as a different income cap. We'll have to see where this lands. Anne-Marie, as you well know, we're watching really closely in the Senate. Bill Cassidy, a Republican from Louisiana, the chair of the Senate Help Committee, he has been shepherding forward a different proposal completely that would put more money in health saving accounts in a bid to try to help Americans with higher out-of-pocket costs. We're going to watch closely how that proposal evolves, but at this point, it's an open game.
Tyler Kendall, thank you so much for that. It's great to have you back. Welcome back to the show. Joining us now is Patrick McHenry, a former House Financial Services Committee Chair. Patrick, great to have you. Thank you so much for being with us. What do you make of some of the noises coming from inside the White House about some controversy about how to message affordability issues?
Well, it is the driving issue. It's the driving issue that brought President Trump back to the White House 1 year ago, and it's a driving issue for voters at the last election. That message is very clear to the White House, and they have their best economic messenger, Scott Bessent, out there delivering what is a distinct message for this administration. They're going to address it. They believe that they can conquer it, and they can actually get to a prosperity message rather than just conquering the price of things. But it's going to be a tough effort because the stickiness of inflation has impacted Fed policy. It obviously impacted, and the last administration was unable to do anything in substance about it. But the president believes they have a very good economic message. They have to just deliver on the regulatory relief and the tariff negotiations that are foremost with this administration.
Do you think the president himself needs to really look at the words he uses when he talks about affordability? There's this Wall Street Journal article that a lot of aides told him he needs to calibrate his message, because remember, during the Biden administration, they would tell you the economy was doing so well, but people weren't feeling it because of how high prices were.
Well, look, the Biden administration was, don't believe your lying eyes. The economy's fantastic. Do not believe what you actually feel. That is not a winning message. It's a very bad message for politicians at every level to tell the voters that they're dumb and they don't know what they're thinking. So you see a few things that the president floated, that this was a really partisan initiative to talk about affordability. It was coming from the left. I think you're going to see that dialed in the coming weeks and coming months. And I think the clear message here came from Scott Bessent this weekend, going out with really what is a honed economic message that they have deeply contemplated.
Patrick, with all due respect, you say that it was a losing message from the Biden administration. Do you think that affordability is a hoax, a winning message coming from the White House currently?
No, not at all. And so what I'm saying is the president is going to hone a message that is distinct, as he does. And we're all going to watch. His aides are going to watch how he hones it. But no one's going to control his message. They didn't do it the first term. They're not doing it the second term. But when Scott Bessent is out with a very honed, very focused economic message, that's the person we have to dial to. We'll see what Kevin Hassett does this week and whether or not they've doubled down on the Bessent message. That is actually a much more winning message than what President Trump rolled out, which was an echo of what Biden did in his final year or two.
Patrick, do you think that messaging is enough? Or do you think that it's sort of imperative on this administration to deliver $2,000 checks or deliver other kinds of more significant measures that make people feel immediately like they are getting some sort of immediate benefits?
No, the immediate benefit has to come from the regulatory relief they're driving the agencies, which takes time for it to be felt. The tax bill that was signed into law in record speed, 6 months earlier than they did in the first term, those things will have effects. But the big driver here and the big drag on the economy are tariffs. The cost of things coming in the United States are more expensive because of tariffs. That does have an impact on the economy. It does have an impact on people's lived experience. Getting that right is the biggest economic delivery this administration could have. That is far better than any word that any politician can utter.
Patrick, do you think we're going to see some sort of reconciliation from Democrats and Republicans on what to do when it comes to health care. This week, we should have a Senate vote on the enhanced Obamacare subsidies. And I'm just wondering if we're barreling once again, maybe on January 30th, to another government shutdown.
I think that's the most likely scenario, is that we're barreling towards no extension of healthcare policy, and then brinksmanship when it comes to government funding. These things have not been resolved. The Democratic Party has offered not what they said they would offer, which was a one-year extension. They're asking for a 3-year extension of policy. They're unserious. Republicans have had this problem for a very long time on healthcare policy. It's not that they lack a plan, it's that they have too many plans. And so we're seeing this offering on the Senate floor this week, where you have multiple Republican proposals, none of which will get 60 votes. And then we see a unified Democratic Party on a singular approach, which is continuing subsidies. I think this is headed for a train wreck rather than a compromise.
Former House Financial Services Committee Chair Patrick McHenry, thank you so much for those insights. And if Delta and United and American Air executives were listening to this, they're hiding under their desks saying, please don't. Come on, we just experienced these losses.
And if you're a Fed official, potentially you're also hiding under your desk, because what does a government shutdown mean? It means that you don't have the essential workers going out there collecting data. And how controversial already is the data thus far? Because individuals are talking about, well, the government was shut down. How credible is this data going to be? It's so delayed. The Fed's not even going to have the most up-to-date data when they meet next week. Can you imagine we repeat this entire conversation again the start of next year? It'll be another Washington self-inflicted, induced crisis.
Well, especially given the fact that there are real questions about what revenues are coming in, as Patrick McHenry was just talking about, a real pushback now with some of the tariffs. We haven't even gotten that IEEPA ruling. That could come early next year.
That can come early next year, and then that would potentially put a lot of corporate America in this awkward situation. Do we go and try to get a refund? Do we wait because we know they're going to use other tariff avenues to make sure tariffs stay? There's still some uncertainty in 2026, even though a lot of people think we're past peak tariff.
Well, it's going to be a lot of fun. Everyone's very excited for that right now. We're seeing markets pretty sanguine ahead of the open. Coming up, Victoria Fernandez of Crossmark navigating shifting trends in the market. Plus, Danny Berger with your morning movers. Carvana among the names jumping with new additions to the S&P.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Seems to be countdown to the Fed as futures pointed upward once again, potentially a third consecutive week of gains on the S&P, on the NASDAQ. You're seeing about a 0.1% gain on the S&P 500, although fading just a bit throughout the morning. NASDAQ outperforming up almost 0.2%. The Russell 2000 banking on those Fed rate cuts up 0.4% after tremendous outperformance over the past couple of weeks. When you take a look at 2s, 10s, and 30s, last week we saw the biggest sell-off in 10-year yields, 12 basis points in 1 week that we've seen going back to April, continuing that move up 2 basis points, 4.15%. On the 2-year, under 3.6%, still 93% chance of a Fed rate cut. And then that 30-year yield, watch Japan, watch Europe, 4.8%. How much are we seeing this inflection higher due to Fed policy? How much is it a global phenomenon? And when it comes to the global phenomenon, it is in natural resources. Copper hitting a new all-time high, given the fact that everyone is stockpiling copper. Dr. Copper used to be a read on the economy. If this is giving any kind of read, it is that everyone is building out everything all at once. And you certainly are seeing that this morning with copper traded on the London Metals Exchange, 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, it's the deal that continues to be the drama saga, and it is Warner Brothers Discovery, the latest of which our reporting suggested that Netflix CEO Ted Sarandos met with Donald Trump, the president, in order to, I guess, get his blessing on this deal. Trump was asked about it at the Kennedy Center. He not only confirmed it, but said he had some serious concerns because it would be a large market share, and that could be a problem. Because of that, and considering Netflix was considered the lead investor in Warner Brothers Discovery, at least the lead in the running, Warner Brothers falls 1%, Netflix gains 1.5%. Next up, some different changes of the composition of the S&P 500. We're getting, Broadcom shares. We'll get to that in a moment. There we go, the magic of TV. These are the shares that are being added to the S&P 500. And this always gets a big rally for these companies just because of all the passive flow that goes into the S&P. So you have Carvana, CRH, Comfort Systems, Carvana up as much as 9%. There's a lot of front running of this, so sometimes the gain isn't as big. In the case of Comfort Systems, those shares up 1.8%. Got a little teaser of it before. It is Broadcom. Those shares are up 1.7% this morning. It's a story from the information that Microsoft has tapped Broadcom to make custom chips for it. Broadcom seen as one of the bigger rivals to NVIDIA, not completely there yet. Even so, those shares up in the pre-market, Lisa.
Thank you so much, Danny. On our radar this morning, Ukrainian President Volodymyr Zelensky saying negotiators are divided over territory in the U.S. peace plan. This coming as President Donald Trump expressed disappointment in Kyiv's handling of the deal. Some new comments coming out this morning, Anne-Marie, from Volodymyr Zelensky as these negotiations and meetings continue to take place in Europe.
Right, and he made these comments actually to our colleagues at Bloomberg News. He says there are visions of the U.S., Russia, and Ukraine, and we don't have a unified view on Donbass. Of course, when it comes to Donbass, there was this proposal, and definitely what Russia wants to see is Ukrainian troops being completely withdrawn from Donbass. The Ukrainians say, we are there, this has been our territory, we are not going to leave what we have left of this territory behind. Zelensky also says this, and it makes it a bit more interesting after Trump's comments last night. He says, there's one question I and all Ukrainians want to get an answer to. If Russia again starts the war, what will our partners do? He really wants these security guarantees at the end of the day. And it's very unclear where exactly the U.S. is going to line up on that, but it is very clear where Europe is. And I think that's really where he's leaning on right now for that support.
Because that is the consistent support that he's gotten. And it's interesting, in light of some of that, J.P. Morgan, Jamie Dimon coming out over the weekend and saying that a weak Europe is bad for the U.S. Europe has a real problem, talking about the bureaucracy, a real tension, and it seems to have to do with corporate policies in addition to some of the international strength that people are wondering how much Europe really plays into it.
Right, and when it comes to Ukraine, Zelensky is on his way to London, so he's going to be sitting down with a host of European leaders. This is something that we do know that Brussels and Washington do want an agreement at the end of the day, but they do want to make sure that it's putting Ukraine with an upper hand and not all the work that they had in terms of sanctions, freezing assets, has gone to waste.
Yeah, meanwhile, President Donald Trump raising antitrust concerns over Netflix's planned acquisition of Warner Brothers Discovery. The president warning the deal creates a market share that, quote, could be a problem, signaling a potential lengthy Justice Department review. And you do see an increasing skepticism priced into market expectations of this deal going through this morning. Meanwhile, after a 15-year-long bet on tech, Wall Street veteran Ed Yardeni is going underweight on the Magnificent Seven stocks.
There's a lot of competition. The profit margins have been awfully high for the Magnificent Seven. That usually invites a lot of competition, and that's exactly what's happening.
Yardeni also seeing little reason to continue overweighting the United States, citing the large market size and cheaper valuations among global peers. Let's stick with that story. Victoria Fernandez of Crossmark sharing the cautious sentiment, writing, for now, the bullish narrative can be found, although the pinball movement of risk-on and risk-off sentiment tells us to be selective. Victoria joins us now for more. Victoria, wonderful to see you in person.
Pleasure to be here.
It's great to have you. I'm just curious what you think about what selective means. Do you think that it is sort of similar to Ed Yardeni's point, which is moving away from some of the highest flyers and looking elsewhere for potentially more upside?
Yeah, I think you have to look somewhere else right now, and we've actually been a little bit short the Mag 7 names for a while. We felt the valuations were too high. There was too much hype around these. We were concerned around some of that cyclical financing and things we've seen. So we've been short for a while on those names, so that makes sense to do that, trim some of those names and look somewhere else. It's those rotations in the market where you really want to look, and we're just now starting to see them. Healthcare has been trending for a little bit, but now you're starting to see it, like you said, in the metals, right? In copper, in aluminum, in zinc, and you're seeing that globally. You're starting to see it in transports. Global autos are doing a lot better. You're even starting to see it in home builders. So I think you have to start looking at some of these areas where trends are starting to change internally. That's where you want to invest.
And just to be clear, when you say short Magnificent Seven, you mean underweight, not necessarily.
I do mean underweight.
Okay,
I'm
so
sorry.
Just make sure that people don't take that and say, okay,
Yeah,
the next Michael Burry.
No,
yeah, I don't
poor
think
Bob
so.
Dahl, our
Yeah,
CIO,
okay.
was probably having a heart attack.
That's why I wanted to help you out here.
Yes, we were underweight Mag 7.
Okay.
They are still actually, Microsoft's still our largest holding in our portfolio.
Okay.
Yes.
Well, when you talk about a rotation, how much is that predicated on a reacceleration in the U.S. economy that has to come with more fiscal accommodation, with more monetary policy accommodation? How much is that sort of quintessential in the ongoing rotation that we have seen over the past few weeks?
It's important that we continue to have that rotation happening. I think we're seeing it a little bit. You're seeing these green shoots start to come out a little bit. There was so much concern for a while, labor market weakening, ISM manufacturing is not good. We had Jamie Dimon come out and talk about the cockroaches and all of these things, right? But we are seeing these elements. Weekly jobless claims really aren't going as high as what people thought they would. You're starting to see some strength in areas. Spreads are contracting again. There's this element that maybe things could be better, and you have a lot of stimulus coming at the beginning of next year. Not just from the one big beautiful bill, there's the tax components and the R&D components there, but you also have from the consumer side, you have elements coming in, and you have the World Cup. I know the announcement was made over the weekend. $17 billion they're saying it's going to bring into the economy, and the equivalent of 175,000 full-time jobs. So if that comes in, then I think it gives you a little bit of a boost in the first quarter of next year when we might start to see things slowing in the labor market.
And we may be renaming soccer football in the United States of America, which I think a lot of Europeans were very excited about the president's comments. You sound very bullish about 2026, but then you view like the ADP numbers.
Yes.
And those were incredibly weak. What are you looking at in terms of data now, given we have a very difficult, precarious situation given the government shutdown.
It's difficult because you can look at either side of the coin on so much of the data that's out here, and you could either be bullish or bearish. And jobless claims and ADP, I think, that's one element of that. Yes, it's very weak on ADP. You look at the WARN report where companies have to give notifications of any kind of worker adjustment, any kind of layoffs. That's rising, so that tells you that could be something that's going to kind of foresee lower and weakness in the future. Let's see what jobless claims are this Friday. It's the first time we're going to get that in a while. We'll see what that tells us. But remember, it's all about consumption. And consumption is dependent on compensation for the lower income consumer, where we are seeing some weakness, but it's wealth effect for the higher income consumer. That's stock market, that's housing prices. Those are looking stronger for that element, which is where I think you're going to get the support.
If you think there's going to be a rotation, and a lot of people have agreed with you and we're seeing some of it, it feels like deja vu of this time last year. What makes it different?
I think you have to look at earnings. I know there was a lot of concern going towards the end of last year at what earnings was going to look like. Now we've got this really strong picture going forward. For the next 4 quarters, we're looking at double-digit earnings growth. You're looking at revenue growth, 6-7%. Earnings is what's going to drive the bullish case of this narrative, and I think you've got support there. You're even seeing on small caps, starting to see the expectations come up there. They reached their peak in 2022, and we're nowhere near that level, but you're starting to see that growth in small cap earnings could actually be larger than that in the large cap. If all of that happens, that's your support.
At the same time, you have to wonder if you have earnings that are continuing to accelerate, you have an economy that's doing well, you have a consumer that's continuing to spend, and you have real capital investment. Well, doesn't inflation come back, especially given the fact that we're talking about potential fiscal stimulus? How much does that kind of make you tepid on the debt space?
I think that's exactly the key, and it's probably the reason that if I was sitting on the Fed, and not that they're asking my opinion at all, but if they were,
but we are,
I probably wouldn't cut at this meeting this week because inflation is a concern for me. If you tell me our target is going to be between 2.5% and 3%, I say, okay, we'll give it another 25 basis point cut. We'll see what happens. But it's not. They're saying it's 2%, and I don't see us getting back to 2% anytime soon. I see that inflation pressure being sticky. And so if that's going to be the case, then I think you have that element there that you're talking about.
We do have auctions this week. We have 10-year auctions coming on Tuesday. We have 30-year auctions coming on Thursday at the same time that we have a host of other debt sales trying to get packed in before the end of the year, and we have M&A announcement. When will the market get exhausted, right? I mean, what are you looking for in terms of people saying, no mas, we got it, thanks, cheers, see you next year?
I'm kind of exhausted with the market right now of where we've been. The end of the year, it's been a long year. I think you've got a little bit more to go. I think you've got a lot of companies, and not just tech companies. We've talked about that, right? With the Microsoft, the Alphabet, Oracle, what's been going on with credit in that space. I think that could tire out somewhat soon because of the whole credit story around CapEx with AI. But you've got companies that want to get in there. They want to issue debt before they anticipate rates could go higher, which I think you're going to see maybe not as many cuts, especially when you get the dot plot this week, as people were anticipating for 2026. That means you're going to see yields go higher.
It is wonderful to see you, Victoria.
It's
Thank you so much for being with us.
Ladies.
Victoria Fernandez of Crossmark here. And for that discussion on capital markets, Kevin Foley, Global Head of Capital Markets at JP Morgan, will be joining us at 8 a.m. Eastern. Don't miss that conversation. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Vani Quinn. Vani.
Lisa, thank you. Ukrainian President Volodymyr Zelensky says negotiators discussing the U.S. brokered peace initiative remain divided over territory. This comes as President Donald Trump has expressed disappointment in Kyiv's handling of the deal, which he says Russia is okay with. European leaders are meeting with Zelensky today to discuss U.S. efforts to reach a peace deal. The Wall Street Journal is reporting IBM is in negotiations to acquire data infrastructure firm Confluent for around $11 billion. The deal, which would mark one of IBM's biggest acquisitions in recent years, could be announced as early as today. Confluent is valued at about $8 billion and specializes in managing data essential to developing AI. The Trump administration plans to unveil a farm aid package offering $12 billion in assistance to farmers hit hard by low crop prices and the impact of the president's tariff policies. The aid will include up to $11 billion in one-time payments to crop farmers. It all comes amid rising frustration among farmers on the slow pace of Chinese agricultural purchases. And that is your Bloomberg Brief. Lisa.
Thank you so much, Vonnie. Up next, Netflix's deal starting to buffer.
Well, that's got to go through a process, and we'll see what happens. But it is a big market share. There's no question about it. It could be a problem.
Robert Fishman of MoffettNathanson will not be buffering. He will join us next. I sometimes feel like I am buffering, but here we are on this Monday, heading into the end of the year with gains on futures, poised for potentially a third straight week of gains. This is Bloomberg Surveillance.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1, this is putting the between the rice air. Then make the 4 fingers curl, make sushi shape, then touch this. 2, then turn. Now these 2 fingers, top to the bottom, make the sushi shape the more beautiful. 3, then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1 to 6.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Inflecting higher ahead of the potential Fed meeting where they are going to potentially cut rates. 93% chance priced into markets right now. A little bit of a lift after 2 straight weeks of gains, seeing almost a 0.1% gain on the S&P. Outperformance from both the NASDAQ and the Russell 2000. Seeing a little dollar weakness. 10-year yields inflecting higher. Watch this space, especially with that 10-year auction coming out tomorrow, given the fact that we saw the biggest month of bond yield rises last week, going back to April, and copper reaching an all-time high under surveillance this morning. Netflix's deal starting to buffer.
Well, that's got to go through a process, and we'll see what happens. Netflix is a great company, and they've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him, but it's a lot of market share. He's done one of the greatest jobs in the history of movies, and other things. He's got a lot of interesting things happening, but it is a big market share. There's no question about it. It could be a problem.
Here's the latest. President Trump weighing in on Netflix's $72 billion deal to buy Warner Brothers Discovery, saying it could face difficulty being approved due to antitrust worries. Joining us now is Geetha Ranganathan of Bloomberg Intelligence. Geetha, we talked about this last week. This was going to be an albatross to get through the regulatory hurdles. How much bigger do they get over the weekend?
Definitely got a whole lot bigger with President Trump. I mean, there was first the scoop from Lucas Shaw, which seemed to suggest that Netflix had, Ted Sarandos had actually met with President Trump before the deal. And then, of course, you have him kind of weighing in. This is going to be a very, very long road, Lisa. There is no doubt about it. We're going to get a whole lot of noise. There is the constant question looming about the two services, the Netflix platform with over 300 million subscribers, HBO Max with over 100 to 130 million subscribers. I mean, that pretty much makes up over half the market. And so, you know, the question is going to be whether Netflix is going to be forced to divest HBO Max down the road, but expect a lot of noise. And that's kind of reflected in the $5.8 billion termination fee, one of the biggest fees that we've seen so far in the history of media deals.
Yeah, and a question of how this is all going to get financed. Geetha Ranganathan of Bloomberg Intelligence, stay close. We'll be catching up with you throughout the day and week ahead. Robert Fishman of MoffettNathanson writing, ultimately, we think the likelihood of approval comes down to how successful Netflix will be in defining the market beyond the traditional media landscape. Robert joins us now. Robert, this is one of the most fascinating deals because it's at the cross-section of politics and, frankly, a deep transformation of the media space. How do you expect Netflix to spin this to indicate that they're not quite as dominant as the potential 450 million subscribers might suggest?
Yeah, thank you. So when you look at the market, it really comes down to how you define it. And when you look at the streaming market, Netflix is actually #2 right now to YouTube. That's something that not a lot of people really know out there. So when you think about YouTube and the size and scale of a free platform, that's how Netflix is thinking about this in terms of the share that they get on the total streaming, not just streaming, but the total viewing platform. And that doesn't even include other short form content like TikTok and Instagram. And so really when you define what the marketplace is, that's how Netflix is going to look to take this to the regulatory approval process.
I think most people think that they're just going to talk about Amazon's Prime, Walt Disney when it comes to streaming. So the likes of TikTok and YouTube make this a little bit more interesting. Do you think it's going to work with the regulators?
I mean, time will tell, but I do think Netflix clearly has a point, right? When thinking about who they're competing against and what the long-term view of the media landscape looks like. YouTube is that biggest media player out there. That's what my colleague Michael Nathanson has been writing for a long time now. So we can't ignore YouTube and thinking about Alphabet and these other large digital players when defining the market. So yes, within streaming and subscription streaming, I should say, Netflix clearly has dominated and won that war. But when you think about the broader market overall, I think you have to factor in these other players.
I think we also have to factor in what the President of the United States said last night, Robert. He said that this would be a big market share. It could be a problem after our colleague, Lucas Shaw, reported that the co-CEO of Netflix left the White House, and apparently Trump had said Warner Brothers should just sell to the highest bidder. Do you think the President of the United States getting intimately involved in this deal could potentially mean problems?
Yeah, I mean, there's a lot to still play out here. I think something that we're quietly, very focused on right now is Paramount Skydance really done? And so I think that there's a lot more noise that could come within this whole bidding war. Clearly, Netflix has won in terms of the announcement and moving forward with this regulatory process. But what we're most interested right now is Paramount Skydance going to come back with a either more aggressive bid, or are they going to take their bid and go hostile towards the shareholders?
Robert, this feels existential, and I'm not sure who it's more existential for. It was thought to be more existential for Paramount Skydance, but suddenly there's a real question that maybe for Netflix, it's equally existential. What do you think? I mean, who sort of has the bigger motivation to make this happen?
So I think Netflix has looked at this as an opportunistic, rare opportunity. I think what was their words they used in terms of what this asset and these multiple assets and all of the premium IP that comes with it. Thinking about the Warner Brothers studio, both theatrical, TV studio, and of course, let's not forget HBO and all of the premium content that comes out of that. So from Netflix's standpoint, they also have a lot of amazing data that they've gotten from Warner Brothers Discovery over the years of licensing that content and seeing how it performs on their platform. So for them, they see this as clearly a very unique opportunity that they have to monetize this content, increase engagement, and really, grow the asset in some direction that they think that they could do a much better job of under their own platform than Warner Brothers Discovery could do with a subscale platform. Yes, it's clearly a big platform compared to some of the other competitors, but Netflix just takes it to a different level. For the other guys, and you mentioned Paramount Skydance and even Comcast and what they're looking to do for Peacock, it does become some sort of an existential question because those are the platforms that need this content, we would argue, even more to really help fix and define where their future is going in terms of how they're looking to compete with the Netflixes, Disneys, Amazons of the world. So for them, we do think that ultimately they need it more than Netflix does.
Just quickly here, Robert, was looking at Cinemark shares on Friday, down 8%, AMC down almost 3%. Are movies dead in the movie theater?
I definitely wouldn't call them dead, but this is a new threat that they've been through definitely some difficult years and have gotten through a lot of that and most of that on the other side. This is a new one. And in terms of what this means for theatrical releases, Netflix has already indicated that they plan to keep the business operations, as it currently stands today. That means theatrical releases for Warner Brothers Discovery, but clearly, given Netflix's own strategy with theatrical releases, it raises questions in terms of what that ultimately means for how long the window is going to be for the Warner Brothers Discovery releases, the Warner Brothers releases, and what Netflix will look to do with that with their own content. So lots of questions that this raises. So far, Netflix is saying status quo, but I think investors, as you point out, have some skepticism around that.
Robert Fishman of MoffettNathanson, thank you so much for the insight. Definitely Hollywood, not exactly excited about this particular deal.
Oh yeah, front page of Variety this weekend. Is Netflix trying to buy Warner Brothers or kill it? This is huge trepidation across Hollywood on what a streamer wants to do with their massive catalog and their massive studio. This is an icon in Hollywood, but of course at this moment, can Netflix really say they want to really shake it up, as they know that the main hurdle ahead of them is getting this through the DOJ Antitrust Committee?
Yeah, and it comes at a time of a lot of deals. We're going to be talking about some other deals in the tech space in addition to that behemoth in the media. Coming up next, Anastasia Amoroso of Partners Group, Henrietta Trey's of Veda Partners, Jordan Rochester of Mizuho, and Kathy Jones of Charles Schwab. This is Bloomberg Surveillance. Good morning.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
So I know from owning a sports team that owning one team takes a lot of energy and time.
Tell me about it, yeah.
So you decided after you bought the Washington Spirits to buy some other soccer teams. So you bought stakes in a team in England, is that right?
Yes. I bought a team called London City Lionesses, and that is the only one of the two teams in the entire, potentially Great Britain, that are independent. 99% of the teams in Europe are part of the men's team. But this is one of the only two teams that was independent.
So now you have two soccer teams, one in England and one in the United States. So I would think for most people that might be enough, but you decide to buy a team in France as well?
Yes. Olympique Lyonnais Feminine is actually the best women's team in the history of women's football. In terms of how many trophies the team has won, they are the 8 times champions of the Pan-European League. And I can't even count how many times they won the French domestic league, the most successful team. I want to professionalize women's sports, right? I don't want people to think that somehow women's sports is a charity or a corporate DEI project. This is a legitimate entertainment product, and it is a business.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The economy seems to be really solid.
There's going to be a lot of noise in the first and second quarter in the data.
I don't think the trajectory of Fed policy is dramatically different over the next 12 months.
Almost regardless of who sits in that new Fed chair seat, we're moving into this era of fiscal dominance.
You can pick and choose whatever economic data you want to fit the narrative you want to tell.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Another Monday. Good morning. Welcome to Bloomberg Surveillance. Looking ahead to a key Fed decision with traders positioning for more rate cuts, 93% chance priced in. Oracle earnings on deck with Eddie Ardeni underweighting big tech for the first time in 15 years. And deals abounding. The latest in Netflix's big offer sending reverberations through Hollywood. Trump casting a shadow of doubt. Other deals really coming to the fore. A question here, though, about antitrust and potential political implications.
Well, and the president is putting himself right in the middle of that. He's saying he is going to be part of this, even though historically presidents don't really get involved in this. This would be the antitrust portion of the DOJ that's going to have a very long process because it will be, to the president's point, a big market share, which is why it's so interesting the way Netflix is approaching this. They're not just going after the fact that they're saying, look, we want to compete with Walt Disney and streamers like Amazon Prime. They're talking about the fact that they also want to compete within this more nuanced, newer media space. Think of TikTok and all the content that's coming out of ByteDance TikTok and things like YouTube. Interesting if that's going to land at the DOJ.
Meanwhile, there are lots of deals, right? So this is sort of piles onto other questions around how much the debt markets, how much just stock markets in general are going to accommodate the ongoing deals. Overnight, the Wall Street Journal announcing that IBM is planning to buy Confluent for about $11 billion. This is a tech deal. The interest here is it is related to artificial intelligence and data managing. It also goes to the question of how much is size the only weapon you have in a battle that is heating up and, frankly, facing a lot of questions about how long it can continue with respect to AI dominance.
Well, these 4 years during the Trump administration, everyone was talking about how now is the time to get deals done. There's going to be this deregulatory push, maybe a lighter regulatory touch in Washington, D.C. But, of course, when it comes to anything touching AI, the question still remains, and a big one into 2026. You look at this, the Bank of America survey on credit, is this idea of the circular financing. How much trouble is actually AI in? And in 2026, are we actually going to see the companies that are benefiting from AI, not just the massive players like NVIDIA, basically, Microsoft and the likes.
Yeah, everyone's a tech company in Ed Yardeni's mind, which is the reason why he is going to underweight big tech for the first time in 15 years. Meanwhile, people are overweighting the chance of a Fed rate cut, 93% chance priced into the market right now, with Fed Chair Powell in a very lame duck meeting on Wednesday where he's going to get out, give some signals, and the market will have to take it as it is, really looking toward that decision as the hallmark event. But we're also getting data, JOLTS data coming out tomorrow, job openings. On Wednesday, we get the employment cost index, which is going to be key to understanding the inflationary pressures. We also get Oracle earnings, jobless claims, Broadcom earnings. That's all coming out on Thursday, with a smattering of bond auctions thrown in for good measure. In markets, we are seeing an inflection upward, sort of lift to the spirits of people hoping for some sort of Santa rally heading into year-end, up about 0.1% in the S&P following 2 straight weeks of gains. We had seen the outperformance coming from the Russell 2000. We continue seeing that outperformance this morning, given that expectation for the Federal Reserve. Euro-dollar seeing that dollar weakness just continuing to mount, almost at 117 on the euro-dollar cross. 10-year yields inflecting upward once again after the biggest increase in yields in 1 week, going back to April last week, and copper reaching an all-time high. It is copper's world. We're all just living in it. Coming up this hour, Anastasia Amoroso of Partners Group. As Wall Street looks for another winning week, Henrietta Trey's of Veda Partners as the Trump administration prepares to unveil billions of dollars in aid for U.S. farmers. And Kathy Jones of Schwab with investors keeping a close eye on the Federal Reserve. We begin this hour with stocks hovering near record highs after weeks of fluctuation. It hasn't been a straight ride up. Anastasia Amoroso of Partners Group writing, higher highs may still lie ahead, and should volatility return in 2026, we are prepared to seize the opportunities it brings. In other words, buy the dip. Anastasia joins us for more. Great to see you. Thank you for being here.
Good morning, Lisa.
So there is a different feeling, though, heading into next year, that maybe the leadership is going to be different. Is there anything in terms of the opportunities that you pick up, the volatility that you want to buy, that indicates a shift in terms of who is going to lead 2026?
Yeah, that's right. I think the air does feel a little bit different because we are starting with, pretty elevated valuations, very tight credit spreads, and sort of this abundance of concerns, whether it's about AI valuations or the AI exuberance or, private credit even. So I do think we have to go into the year saying, look, the backdrop for markets is supportive. The tailwinds from policy are still there, but we have to be more selective. We have to be more discerning. And so, for example, at Partners Group, as we think about underwriting transactions, we have to think about, can this company work its way through an entire business cycle? If there is a turn in the economy, can it withstand it? We also have to think about what multiple are we actually paying and what is the exit multiple likely to be? Will it actually be higher from where it is today? So those are the types of considerations that you have to have when you're investing at high altitude. And, I would say also when we think about within our private equity business, for example, control investments versus secondaries, we do have a preference towards control investments, for example, because multiple is one thing, but the ability to control the outcome of operational value improvement or the earnings growth is another, and we prefer to have that control. While the secondaries discounts, for example, have closed in, they're at a 13% discount for private equity for secondaries and somewhere closer to 6% on the index level. So that's how the preferences have changed.
It's fascinating to hear the way that you talk about this, because on one hand, when you talk about opportunities and we hear a lot of the optimism around Wall Street for 2026, it comes with this expectation of a reacceleration of the U.S. economy.
Yeah.
What you're talking about is trying to be independent of the economic cycle. Can you sort of explain why that is crucial now, given that everyone expects fiscal and monetary support to lift all tides in 2026?
Right, that's right. Well, that is consensus expectation. We expect the tax cuts to benefit the economy. We expect the rate cuts to benefit the economy. And I also think the midterms kind of mindset should also benefit the economy, but that is consensus. And, there's nothing wrong with consensus, but when you couple that with those high valuations, that's why we have to kind of think a little bit differently. And so once again, we do develop a variety of stress test scenarios where, it might be base case growth, it might be stagflation, it might be a productivity boost, and we want to invest in companies that can kind of persevere through a variety of those.
You asked a question in your note, what could sustain progress towards new highs in 2026? And it's policy once again. Besides the fiscal impulse, which already pretty much is baked in because that happened in 2025, in terms of we are expecting that, what else do you think we can get in terms of policy?
So I would say three things to that. So first of all, yes, the rate cuts are baked in as far as the yield curve, shows you, but they're not actually baked in as far as the economic impact. And so we are expecting the Fed to cut rates again this Wednesday. So 75 basis points all in, but 75 basis points is on a $11 trillion of floating rate debt that has to reset lower in the U.S. economy. It's starting to reset lower, but not all of it has reset just yet. The other side of that coin is you do have fixed rate maturities and the refinancings of those that have to take place. So for example, there's about $1 trillion of corporate maturities that have to be refinanced. So as that happens, that's the impact that will be actually delivered to the U.S. economy. So that's the first thing. The second thing is the tax cuts, once again, is consensus, but whether it's getting larger refunds that we've been accustomed to or paying less in taxes, and also corporations benefiting from some of those enhanced R&D expensing, all of that is still to come in 2026. And the last thing, Anne-Marie, I think you'll appreciate this, kind of looking at the political spectrum, we're heading into the midterm elections, and if you are a Republican voter, you feel great. If you are a Democratic voter, you feel not at all great. And if you are an independent, you felt pretty okay coming into the year, but that confidence has slumped throughout the course of 2025. So I do think the administration is going to try to do something to shore up consumer confidence, specifically of that independent cohort going into the midterms.
I'm glad you brought that up. University of Michigan, we always joke, is very partisan, but in January, it had a 70 reading.
Right.
Now it's at 53. It's better than last month, but it's still pretty weak. Do you think everything you just discussed is actually going to change how the American consumer feels next year?
I think the administration is going to try, likely to make moves to change that, because you can't go into the midterm election year with, basically record low consumer confidence and expect a good outcome. So I think that's why we're starting to hear some of those measures, maybe rolling back some tariffs on certain line items, maybe, providing that $12 billion slight stimulus to the farming industry. So I do think in 2026, we will see more measures that are designed to shore up that confidence.
A lot of that people have pointed to for the weakening in the dollar. A lot of that people have pointed to for the steepening in the yield curve, although other people might argue that it's a global phenomenon. How much does that change your desire to buy U.S. assets over international ones based on this question of what type of stimulus will ultimately drive inflation, will then drive some sort of monetization of the debt, and then will drive some sort of shift away from the dollar?
Right. Well, first of all, I was never personally in the end of U.S. exceptionalism camp. And, part of the reason for that is U.S. still has one of the lowest corporate tax rates that's out there amongst developed market economies. We still have a solid consumer foundation. And now we have this economic stimulus that's coming. So it's hard to avoid that, despite currency fluctuations. So I think we have to have presence in the U.S. Oh, and by the way, it has the AI, trade, and innovation. But at the same time, I think, Lisa, what's changed is this notion of localization of supply chains and this notion of fragmentation. That is different, and that is here to stay. It's not only here because of the current administration and the trade policy, it is here because of COVID as well. So what that tells me as an investor, I can't just buy a U.S. company that's multinational and expect that to sort of check all the boxes. That's why we are big believers in regional diversification. And, on our platform, we have probably 40% exposure to Europe, for example, because there's a different set of economic stimulus that we expect coming out of Europe. We do think the ECB has scope to cut rates 1 or 2 more times in 2026. And at the same time, Germany went from running a budget surplus to running a budget deficit. So that should shore up the European economy as well. So to us, it's not a matter of one or the other, but it's a matter of making sure you have exposure to both to capture that growth.
Are you stockpiling copper in your basement?
No, not recently. No. Are you?
We'll check back. Not yet, but I've thought about it.
Remember when they were trying to get you, Tom and John were trying to get you to buy
oil when
it was -0?
Yeah, a bit of a question with the Children's Administrative Services when I tried to put it in their room. Anastasia Amoroso of Partners Group, thank you so much for being with us. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. President Donald Trump raising antitrust concerns over Netflix's planned acquisition of Warner Brothers Discovery. The president warning the deal creates a market share that, quote, could be a problem. The comments escalate pressure on federal regulators. Meanwhile, Unilever's Magnum ice cream starts trading today in Amsterdam, London, and New York. The spinoff was valued at over $9 billion. The company, which owns Ben & Jerry's and Cornetto brands, is debuting a month later than initially planned after the listing was delayed by the U.S. government shutdown. Do you have Magnum a lot? I don't know. I'm
no,
usually a
I'm
Haagen-Dazs
dairy
person.
free,
Oh yeah, there you go. All right, so going with some soy latte stuff. French President Emmanuel Macron warning the EU may take strong measures against China, including tariffs if Beijing fails to address its trade imbalance with the bloc. Macron says it's a, quote, question of life or death for European industry. And that is your Bloomberg Brief. Up next, a bridge for farmers.
If everything's fine, then why do farmers need a bridge payment from the Agricultural Department?
Because these prices haven't come in, because the Chinese actually used our soybean farmers as pawns in the trade negotiations, and we are going to create this bridge.
Henrietta Trays of Veda Partners joins us next. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Coming into a new week with new gains ahead of that Fed meeting on Tuesday and then into Wednesday when we get the rate decision and the press conference afterwards. Right now, futures inflecting higher, up 0.1%, led by the Russell 2000 once again. Can we get that rotation back underway, up 0.4%? The NASDAQ also doing better than the S&P, up 0.2%. A real question of how much the Russell 2000 can keep outperforming without the participation of a rally in the bond space. Right now in the bond market, you are seeing a lift to yields across the board, priced down, led by the mid section, right? The 10-year yields, which saw a huge sell-off last week, continuing that grind higher in terms of yields, price lower, 4.15% on that 10-year, ahead of a key slate of auctions this week. We've got $39 billion of 10-year notes being sold tomorrow. We have $59 billion of 2-year notes being sold later today. A question about the appetite here, especially given discussion of more fiscal stimulus. Under surveillance this morning, a bridge for farmers.
If everything's fine, then why do farmers need a bridge payment from the Agricultural Department?
Because these prices haven't come in, because the Chinese actually used our soybean farmers as pawns in the trade negotiations, and we are going to create this bridge because, again, agriculture is all about the future. You've got to start financing for planning next year, when things will be very good.
Here's the latest. The Trump administration planning to release a farm aid package today, offering $12 billion in assistance as farmers feel the impact of tariffs and low crop prices. Bloomberg's Tyler Kendall joins us now. Tyler, this was widely expected for a while. Do we have a sense of the details of this plan?
Yeah, hey, Lisa, good morning. And you're exactly right. A USDA official does tell me that the administration has been working on this for months and that it was initially delayed due to the government shutdown. But this is long-awaited aid for a key support group for this White House. Bloomberg News is reporting that it will include one-time payments to crop farmers under the Department of Agriculture's newly designed Farmer Bridge Assistance Program. About $11 billion is going to go to what we typically think of as crop farmers, and then the remainder amount of that money is going to go to those not typically covered under this program, such as specialty products. Of course, though, this is going to include soybean farmers, which have been hit particularly hard by the trade tensions with China, even as China does gradually resume its purchases after that agreement was reached between President Trump and Chinese President Xi Jinping in October. And since then, we have seen a run-up in soybean futures, yet prices still remain near some of their lowest levels since 2020. And at this point, if we look at the data, China has only made good on about a quarter of its purchase commitments to the U.S. when it comes to soybeans for this harvest season, though, of course, Beijing does still have until February. Just for context, of course, this does continue a policy that we saw under the first Trump administration, which gave about $28 billion to farmers between 2018 and 2019. Lisa, we will get fuller details later today at 2 p.m. Eastern. President Trump is holding a roundtable at the White House with farmers where he's expected to announce this package alongside the Treasury Secretary Scott Bessent and the Agriculture Secretary Brooke Rollins.
Tyler Kendall, thank you so much for the details. They'll be catching up with you throughout the day and week. Henrietta Trey's of Veda Partners joins us now for more. Henrietta, what's your takeaway from the approach of the administration when people are starting to feel the pain? You plug the gaps with some sort of aid package or cash infusion.
Yeah, it's a replay of the Trump 1.0 playbook, which is, trade wars are political. So if China is getting hammered by U.S. tariffs, their retaliation function is to go after U.S. farmers. So I believe we did this exact same bailout package 3 times in the president's first term, that it took him 11 months to roll it out in his second term is surprising. But as Tyler pointed out, it was mostly due to that government shutdown. They couldn't get the CCC under the USDA funded with the backlog of cash that they could then siphon off to farmers. So now the government's reopened, they can get that aid flowing. Given China is well below its purchase commitment for 2025, we're probably going to see at least 2 more of these bailout packages emerge in 2026. And that's something that Republicans on Capitol Hill will have to, explain to farmers is, a trade-off for the president's immigration policies, for the tariff policies, higher fertilizer costs and all those components that will persist into 2026.
We also have potentially one plan regarding beef prices about potentially letting more cattle from Mexico come in. Henrietta, do you think the administration is going to take that approach? This was some Wall Street Journal reporting.
As cost for consumers remains at the foreground and we go into a 2026 midterm election cycle, your grocery price issues are going to be front and center all day, every day, along with electricity, beef, milk, eggs, all those things that consumers are buying every single day. So this is another strategy where the administration can go after the meat packers, try to include more trade with other nations. Brazil was one that got the cattlemen ranchers really worked up, and move into Mexico makes sense given we're going to renegotiate the USMCA over the next year. There's a lot of moving parts, but the White House needs to get this affordability narrative under control, and they're going to have to cover all their bases.
Well, on Saturday, they called for the DOJ and the FTC to look into potentially really anti-competitive behavior that exists in corporate America. This is very reminiscent of 2023, 2024 Biden administration when they were talking about price gouging and shrinkflation. It didn't work for Biden. Do they think it's going to work for Trump?
It's really just about getting a message out here. I think you're making it exactly the right point, and the administration tries to do it all the time. Consumers are getting smoked from all ends, whether it's healthcare, housing, groceries, apparel, industrial, anything that they want to buy, from a car to a refrigerator. All those prices are up and elevated, and they have not come down from the Biden administration or at the end of COVID under the first Trump term. So that persistent issue of inflation and prices is perennially number 1 and 2 issues of every American voter poll that's taken from every pollster, whether it's Fox News or The Economist. Everybody's seeing that the number 1 issues for the U.S. consumer are inflation and prices. So tackling all these components through whatever means they can, and just even the appearance of trying is sometimes the most you can do from the White House. So it's no surprise that they're repeating what the Biden administration did as a way to just try to say that they're focused on affordability.
Well, what's Congress's role going to be in this? We just had the longest government shutdown in history, and then potentially, and Patrick McHenry, the former Finance Committee chair, was talking about how he's expecting another government shutdown come January 30th.
Yeah, unfortunately, I had to raise my odds from 20 to 25% that we shut down on January 30th as well, mostly because they're not going to find a fix to the ACA subsidies issue. And this is on the healthcare front. You know, you're looking at price increases for 22 million Americans of between $200 and $920 per person, depending on your age. So there are these price hikes coming through, along with, you know, higher electricity bills and continued tariff authority, and, you know, all these issues that are facing the U.S. consumer that keep inflation front and center, prices front and center. So getting the government functioning to the point where you could even pass legislation to help them out is really basically a 10% or less scenario, in my opinion. The fact that they are probably going to, you know, potentially going to shut the government down again at the end of January just speaks to the dysfunction in D.C. There's so many retirements. There's so much, you know, incompatibility and anger between the two parties, and even intra-parties sometimes. I don't see a lot of ways to get things moving from D.C. going into next year.
Well, Henrietta, just to pick up on that point, I am wondering how much the president is losing his clutch over the Republican Party, given the fact that there is increasing pushback, not just with respect to the messaging over affordability, but also with respect to the handling of Defense Department leader that we've heard over the past couple of weeks over the signal issues, as well as what happened off the coast of Venezuela. I'm just wondering, do you see increasingly hardened divisions between President Trump and the rest of the Republican Party?
You know, I think there's a couple things here. One, you're seeing about 24 Republicans announce that they're going to retire rather than run for re-election. You can redistrict all you want, but it's not netting out for a winning scenario for the Republican conference when one party controls all of D.C. So now we have 3 major states, Tennessee, New Jersey, Virginia, that have held elections since Trump got elected, and Democrats are winning by anywhere between 12 and 22 points. That suggests a wave election year, which is normal for any year when, you know, one party controls all 3 chambers of Congress. So as we head into 2026, what you're starting to see are losses. And that means that we're already talking about 2028. We're already in sort of a lame duck session for the president, and that's going to become more of the narrative. That makes it harder for President Trump to exert, you know, material control on his voting members, who are going to now pivot from getting through a primary election cycle into a general election cycle, where their challenger is not, you know, a far right or moderate Republican, but now a Democrat, and they have to moderate themselves, and that creates fissures within the party, and you'll see that throughout 2026. It's only going to build.
Henrietta Trey's of Veda Partners, thank you so much for being with us. The idea of another government shutdown, I'm sure, sends chills down the backs of everyone who's ever in transportation, as well as, frankly, looking for government data.
Also those that are federal workers, and potentially they're not going to get another paycheck. Henrietta is talking about what we're seeing in polling. I think we should note, polling, people are saying high prices, still a problem. It's been a problem since COVID. It was a massive problem to the Biden administration, and it's still lingering. But some of the data, especially out on the heels of Black Friday, show the American consumer still has been resilient. They are still going out and spending. Wall Street Journal says, you know what? They're just cranky. Not choiceful, they're cranky.
Well, and this is the reason why people have some more optimistic views for next year. Coming up next, Jordan Rochester of Mizuho on the potential market game changers in 2026. Plus, Danny Berger with your morning movers. Tesla shares sliding on the back of an analyst downgrade. Those shares down by 1.3%. Good morning.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Used to be one would say, what's that got to do with the price of tea in China? When they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
So maybe it really is going to be the Santa Claus rally December that people were expecting. We did see 2 straight weeks of gains, although just now climbing back toward all-time highs, up about 0.1% on the S&P, just grinding higher, but staying around that level throughout the morning. A bit of dollar weakness. Watch the space. The Bloomberg Dollar Index has been slowly grinding weaker over the past few weeks, continuing that trend this morning, 116.49 on the euro-dollar cross. 10-year yields continuing to climb before that auction on Tuesday, tomorrow. 10-year yields 4.15%, and copper at an all-time high, 2 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa, we start with the deal of the day, the month, the year, perhaps, and it is the drama over Warner Brothers Discovery. Over the weekend, President Trump at the Kennedy Center telling reporters that he has looked at the deal and the giant amount of market share if Netflix buys Warner Brothers Discovery could be a problem. In his words, we know Ted Sarandos of Netflix went to the president to try to get his blessing. Most of the losses have eased off. Warner Brothers Discovery now only down 0.7%. Netflix rallies again just up 0.5%. Elsewhere, in terms of moves that we are seeing this morning, Tesla shares falling 1.4%. Morgan Stanley downgrading from overweight to equal weight. We also have a new analyst taking over from the longtime Tesla analyst and issuing this new call, basically saying all the non-auto related news that it's already priced into the stock, so it just lessens the upside. So again, Tesla trading at 448 this morning. Finally, wrapping things up with CoreWeave moments ago announcing that they are issuing $2 billion worth of convertible bonds. A couple things going on here. One, it's just a dilutive event, so shares tend to fall. But again, it's this concern about growing debt piles by tech giants in order to fund some of the AI spending they're doing. So CoreWeave shares down 5.2%, Lisa.
Thank you so much, Danny. Just crossing about a half an hour ago, J.P. Morgan tapping Berkshire Hathaway's Todd Combs to head its strategic investment group. At Berkshire, Combs helped oversee parts of the company's $283 billion equity portfolio alongside Warren Buffett and Ted Weschler. The move comes amid a shakeup at Buffett's firm as the company prepares for his retirement, and it really goes among a whole host of departures that we've seen at Berkshire Hathaway. Two sides of the story. On one hand, with a Berkshire Hathaway going forward, post Warren Buffett, as he does enter a quiet period ahead of his retirement. But then a real question around the strategic initiative over at J.P. Morgan that Jamie Dimon announced. Todd Combs will be reporting directly to Jamie Dimon with a key initiative that really does seem to be a linchpin for the bank strategy going forward.
They've been talking about these economic security concerns. They want to put $1.5 trillion into these industries that is critical to the United States. You think of things like rare earths, building out data centers. Individuals that sit on this committee within Jamie Dimon are individuals like Condoleezza Rice, former Secretary of State, former Defense Secretary Gates, individuals like Jeff Bezos. They are going all in on this, and they clearly see, especially with him reporting directly to Jamie Dimon, as being a pillar when it comes to these investments.
Yeah, and it comes, just to put this in perspective, Tom Combs is leaving Berkshire Hathaway after not getting the CEO position. and he was thought to be a successor. So this kind of shifting in the sands we're seeing across a whole host of Wall Street firms as we do see people stepping down and paving the way to new leadership. Meanwhile, under radar, President Trump raising potential antitrust concerns around Netflix's planned acquisition of Warner Brothers.
Well, that's got to go through a process, and we'll see what happens. Netflix is a great company, and they've done a phenomenal job. Ted is a fantastic man. I have a lot of respect for him. But it is a big market share. There's no question about it. It could be a problem.
The Justice Department will be conducting a lengthy review of the $72 billion deal, and we are seeing in Polymarket the odds of this deal going through now 25%, down from 60% on Friday.
Because the president, that last line at the very end, he was pretty much fine until he said it could be a problem. So everyone is thinking, potentially, is there going to be this White House that puts up a little bit more of a hurdle when it comes to regulatory process, which the president normally would never get involved in. This is going to be for the DOJ to decide if this really is anti-competitive behavior. And Netflix is starting to get a bit more creative. It's not just the normal streamers like Walt Disney. They're looking at making a case. Look at where the media environment right now is, which is why this is so interesting. You have to think of things like TikTok, things like YouTube, and on that space, they're saying this is how we can remain and be competitive.
Yeah, Merger Monday, meanwhile, making a comeback, and this really has been a theme throughout the second half of 2025. The Wall Street Journal reporting IBM is in negotiations to acquire data infrastructure firm Confluent for around $11 billion. The deal, which would mark one of IBM's biggest acquisitions in recent years, could be announced as soon as today. Confluent is valued at about $8 billion. Confluent shares absolutely surging, IBM flat, but really goes to an existential race among the tech players to get enough data capabilities, to get enough AI prowess, and frankly power in order to remain dominant and remain relevant heading into the next chapter.
Especially for IBM, because they're also putting an emphasis on quantum computing. But I think you're exactly right. This just also goes to show, because there's that need right now, you're going to see a tremendous amount of consolidation in this space.
And you already have seen quite a bit year to date. Turning to 2026, Wall Street predicting a number of market scenarios for next year. Mizuho is out with its Gray Swan report. The team writing, these are low probability, high impact events that sit outside the usual base case and consensus risk scenarios. Joining us now is Jordan Rochester of Mizuho with his Gray Swans. Before we get into the Gray Swans, let's talk about the really obvious sun in front of us. What are sort of the base case that you see as most likely heading into 2026?
Well, I think next year is going to be a year where the consensus has gone into it thinking that the Fed's going to cut rates thanks to a new Fed chair, and that everything will be fine. We'll get to a 3% terminal rate. The one-year pricing is roughly around that sort of level. Let's imagine it's Kevin Hassett, and he'll sway all of the committee to become dovish. But what if the data doesn't turn that way? I guess is the sort of main risk for next year. For us, I think the first quarter and the second quarter, before the new Fed chair arrives, the problem for the market might be that the outgoing Fed chair, Jerome Powell, doesn't cut rates, and as a sort of goodbye to markets. That might be the story for Q1 and Q2.
So let's talk about what the ramifications of that could be. If, let's say, there are 4 dissents for cutting rates at the meeting on Wednesday, and 5 that go for this idea of keeping them where they are, or if it's some sort of mix of the two, how much do you see markets seeing a massive rebound that they don't recover, or massive drawdown that they don't recover from?
Well, I'm sure they'll recover from it. What's been the case for the past 2 or 3 years now is that rates markets have been extremely range-bound. They're big ranges, very tradable ranges, but we haven't really been able to escape the idea of 3% neutral. That's the sort of floor for U.S. rates, up to around 4 or 5% in terms of the highs that we last saw not too long ago. That's a big trading range, so fair enough. But I think the markets are still in this sort of financial conditions loop where the data is so focused, the Fed is so focused on the data itself that the sort of volatility we get in economic surprises keeps us in this scenario where good data equals hawkish Fed, bad data equals dovish Fed. But the problem is data is very cyclical. It's like a sine wave. So in answer to your question, I think the worst case scenario is that we could see US rates getting to sort of 4.8. And that's the sort of level that typically people tend to, I'm talking about the 10-year here, tend to start receiving.
When it comes to potentially these Gray Swan events, low probability, high impact, also fantastic cartoons, Jordan, which ones do you think is the most believable? Because some of these seem like potentially not exactly what is on people's radar, like Germany overheating.
Yes, indeed. The grey swan is the close cousin of the black swan. A black swan is something that's truly unforeseeable. The grey swan is actually something that you can foresee, but it's perhaps a low probability, high sort of impact. And a few of them are actually quite likely. Some you might even argue should be your base case. It's just a risk for next year we need to be aware of, which is the UK. I think that stands out as possibly one of the most likely ones in our list, which is that the UK replaces Keir Starmer as Prime Minister, and Chancellor Rachel Reeves would also be out the door as well. And that the Labour Party would go through an internal sort of fight for the direction of policy. Does it turn left, even further left of centre, or do the centrists win? And that would be a big problem for the UK gilt market. So I'd say of the list of 10 that we have, that's probably the most likely one to watch out for.
You also talk about cockroaches in the woodwork, private credit cracks emerge. Haven't we already seen that? How concerned are you about really that metastasizing, though, into 2026?
Personally, I'm not that concerned about it. I'm not an expert on the credit market, though. You have to ask the credit analysts. But if you look at the sort of impact from it, when Jamie Dimon made his comments about cockroaches in the woodwork, I mean, the news count went through the roof on the topic. The big impacts for private credit, if you look at the sort of indices that track it, or regional banks in the US, which are also hit, they've pretty much recovered back to where they were. So the market's saying, actually, it's not too big of a risk for now, but it's definitely got to be on your radar.
How about the idea of this peace deal between Ukraine and Russia? We've been hearing mixed messages this morning. There are these meetings ongoing between Volodymyr Zelensky and European peers. I'm just curious how much you think that the market is discounting the chance that there will be no peace, there will be no resolution between these two countries.
I think by this year end, the market's got very low expectations. Luckily for us, we have the poly market numbers to work with. It's roughly 50-50 whether we get a deal by the end of next year. And it would matter a lot for Europe, because you'd see the market start to price in sanction relief for Russia down the line, even though it probably wouldn't be immediate. So natural gas prices, which are already falling quite a lot in Europe, by the way, whilst they're rising very rapidly in America, you'd see natural gas prices come down, oil prices come down, the euro would appreciate. We could be talking 125, 130 in the euro dollar rate, because the terms of trade would improve. And reconstruction as well. It's not just Ukrainian fixed income that's trading off the back of this, but you could see the likes of Poland and Hungary outperform, and as well as Germany, as countries that will be helping to support that reconstruction effort.
Jordan Rochester of Mizuho, thank you so much for being with us this morning as you look ahead to the gray swans, the unexpected events. There are many, I'm sure. It should be another exciting year. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Wall Street veteran Ed Yardeni is going underweight on Mag 7 stocks after a 15-year bet on tech. Yardeni research now expecting a shift in earnings growth, suggesting that tech is evolving. Yardeni argues that the rest of the S&P 500 will see improved profits because, quote, every company is becoming a tech company. Meanwhile, China's trade surplus exceeding $1 trillion for the first time, despite a plunge in U.S. shipments, risking a backlash from markets flooded by goods from the world's biggest manufacturer. Chinese exports rising nearly 6% from a year earlier. The surplus shows Beijing's struggle to rebalance its economy away from dependence on foreign demand, and frankly, the rest of the world's struggle with this imbalance. And Southwest Airlines is off the hook for a Biden-era fine. The Trump administration is waiving an $11 million penalty over its 2022's holiday meltdown. The fine was issued after it canceled nearly 17,000 flights and failed to provide fast customer service and refunds. That's your Bloomberg Brief. I have to say, what do you expect if you get delayed on the tarmac for 3 hours, or if you, say, get stranded for 6 hours and then have to spend the night at a hotel? What do you need to make yourself feel whole?
Well, I'm always very annoyed when I'm stranded. I hate spending time on the tarmac. But yeah, I think you want your money back. We should note the entirety of this civil penalty was $140 million. So it's the last tranche that's going to the Treasury Department that they're waiving. But I think consumers hate this, and they just want their money back, or maybe some more. I don't think $5 to spend at the terminal for some meal and water is going to cut
At least some string cheese. Up next, an unbalanced economy.
We look at the economy, right, and it's kind of running on a two-legged stool. I think there's almost as good of a chance that they don't cut as they cut, 50.
Kathy Jones of Schwab Center for Financial Research joining next. This is Bloomberg Surveillance.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Bleeding higher ahead of the Fed decision on Wednesday, as well as a key set of data that actually gives some more real-time sense of the jobs market as well as jobless claims. Right now, you're seeing a gain, a lift to the market near session highs. S&P futures up more than 0.1%. Russell 2000 nearing about 0.5% gain. Meanwhile, in the 2s, 10s, and 30s space, you do see a bit of a decline in price, increase in yields, although back from earlier highs in terms of how much the yields have risen. 10-year yields in particular. Watch this space. After last week, we saw a 12 basis point increase, which is the most since April, continuing that move, although less than 2 basis points, 4.15%. Watch this auction coming out tomorrow. $39 billion of 10-year notes being sold amid a host of other supply in the corporate space as well. And Emery, check out what's going on in copper. Dr. Copper was supposed to indicate that things are going really well in the economy if it's going up and really poorly if it's going down. Right now, we're seeing copper up 33% year to date at record highs and continuing to build momentum.
Absolutely. Last week, the story really was about people front-loading ahead of potential tariffs from the U.S. administration. Today, it's all about China. China once again saying domestic growth is a top economic priority. Well, if that really is going to be the case for China, then that means things like copper are going to do really, really well.
And everybody seems to want to pile into metals that could be used in the build-out of artificial intelligence. Under surveillance this morning, an unbalanced economy.
We look at the economy, right, and it's kind of running on a two-legged stool. I think there's almost as good of a chance that they don't cut as they cut, 50. The U.S. economy is on some, weak footing. So you could be in a situation at any point in the next 6 to 12 months where you do get a leg lower in the job market and in the economy. And in that case, the Fed's not going to cut twice. Right? They'll probably cut 4 times.
Here's the latest. Markets expecting a divided Fed to cut interest rates this week by 1/4 point, despite growing inflation concerns. Kathy Jones of Schwab writing, we expect 2026 to be another good year for fixed income investors. However, yields that are lower and less room for rate cuts will mean less robust returns. Kathy joins us now. Sounds like a coupon clipping kind of year. Kathy, thank you for being with us. I'm just wondering what the limit right now for the Fed really is. Peter Scheer over the weekend was talking about how maybe the Fed has a lot more room to cut than people think because of some of the new personnel on the central bank. Do you disagree?
Well, I think the issue is, Lisa, that you can cut aggressively at the short end of the yield curve, but you can't make 10-year or 30-year yields go lower if the market doesn't believe that that's the appropriate policy. And so I think that's one reason we're seeing the yield curve continue to stay steep and steepen a bit from here, because there's a question of how much is appropriate to cut, whether you have people who are biased to cut or not. the market's going to decide whether that's the right decision or not.
At this point, do you think that the increase that we've seen at the longer end of the yield curve is because of rate cut expectations, or do you think it's because of the global dynamics with what's going on the Bank of Japan side of things, for example?
Well, I think they're all contributing factors. Japan is helping to kind of pull long-term yields up on a global basis, and obviously we know Japanese investors are big investors in U.S. Treasuries, so that is a factor to consider. We've had a weaker dollar. And then we have this sort of mixed data where, you have sort of a two-tier economy where higher income consumers continue to drive consumption, keeping the economy moving along. We're going to have some fiscal stimulus coming in with the expensing that will boost probably corporate investment, some tax cuts for some part of the economy, but then you have lower end consumers who are getting hit with higher prices and